Netflix reported $608 million in net income last quarter, but during the exact same time period, it reported negative $569 million in free cash flow. What is the difference between those two numbers, and which is more important? Watch this video to the end to hear all those details. My name is Brian Feroldi.
And my name is Brian Stoffel.
Thanks to Quarter for sponsoring today's video. All right, Brian, let's start off with some very basic definitions. What is net income?
Well, net income is the profit that remains after all expenses and costs have been subtracted from your revenue.
Net income is found by looking at the very bottom line on the income statement.
Now, it's important to note that the income statement uses accrual accounting. What does that mean? Well, it's a way of accounting that allows a company to record revenue before receiving payment for goods or services sold, or expenses are recorded as incurred before the company has paid for them.
So if we look at the income statement from Netflix in the fourth quarter of 2021, we see that it reported $7.7 billion in revenue. It had $7.1 billion in expenses, and that left a $607 million gain in net income. Sounds great. Now let's talk about free cash flow. What's free cash flow?
It's going to sound really similar, but what free cash flow is taking all the cash that is generated from running your business and simply subtracting out capital expenditures, which is when you spend money on property, plant, or equipment.
Now, free cash flow is found by looking at the cash flow statement. The formula is very simple. It's operating cash flow minus capital expenditures. The difference between those two numbers is free cash flow.
And it's really important to note that instead of accrual accounting, the cash flow statement uses cash accounting. In other words, it simply measures money moving in and out of a business.
Now, as we've noted before, the income statement and the cash flow statement are linked to each other. The very bottom line of the income statement is net income, and that ends up being the very top line of the cash flow statement.
So if we look at Netflix's fourth quarter of 2021, we see that they lost about $403 million by running their business. That's cash from operating activity. They also spent about $166 million on capital expenditures. You put those two together, and the company's free cash flow was a loss of $569 million. That's over a $1 billion difference from their reported net income.
Now, what's interesting about that number is that's nothing new for Netflix, and there's nothing nefarious going on. If you look back to 2019, Netflix reported a net income of $1.9 billion during that period.
At the same time, however, they reported free cash flow losses of $3.1 billion. And now we're talking about a difference of $5 billion.
To understand why this is happening, it's important to dig into the details of how Netflix pays for its content. Let's rewind the clock to 2019. This is the year that Netflix gave the thumbs up to its mega popular show, Squid Game.
So in 2019, when they approved the start of production, Netflix gave away a ton of money to make the show, which meant that Netflix's cash balance went down.
That makes sense because the actors, directors, set designers, etc. all wanted to be paid when they were making the show. That means that Netflix has to fund the development of these products years before they actually are released on the screen.
So if we go back to Netflix's cash flow statement from 2019, we will see that they spent nearly $14 billion on addition to content assets. That includes money that they paid for the start of production for Squid Game.
Now we need to fast forward to September of 2021. This is finally when Squid Game was available for viewing on Netflix.
The show proved to be enormously popular, and the company reported that during the fourth quarter, they gained 8 million subscribers. Now, we can never know how many of those came just because of Squid Game, but it's worth figuring that at least some of them did. So Netflix was finally able to realize a cash balance going up because of their investment in Squid Game.
So how does Netflix account for the expense of paying for Squid Game? This is actually accounted for on both the income statement and the cash flow statement. Let's go back to 2019. During the same year that it was starting production of Squid Game, it was also amortizing the cost of some older shows, such as House of Cards.
So there was nearly $9 billion of content that had already been paid for, but was being amortized during 2019. So to figure out what Netflix's free cash flow was, we take that negative $2.9 billion, we subtract out about $250 million on capital expenditures, and we arrive at the figure of negative $3.1 billion.
So if we were to summarize what Netflix was doing with its capital, it would be essentially saying we're spending boatloads of money right now, as shown on this cash flow statement.
But here's why that's okay, which they can show on the income statement. It's important to point out that these very same dynamics can play out in the opposite direction. And one critical example is Zoom video communication.
During the year 2020, Zoom reported a positive net income of $672 million. Pretty good.
But it gets even better when we look at free cash flow, which was more than twice net income at $1.4 billion.
So what's going on here? Well, we have to break down Zoom's business model. Rewind the clock to March of 2020. That's when schools, businesses, and organizations everywhere all of a sudden decided that they needed to become Zoom's customers.
At that point in time, they paid for an annual subscription to Zoom, so they handed over a lot of money to the company.
So when this happened, Zoom's bank account exploded higher, driving huge gains in free cash flow.
But for instance, during that first quarter, Zoom could only recognize 1 month of payments from those schools, so its revenue only inched up a little bit.
So if we look at the company's financial statements for the year, we saw that Zoom reported a net income of $672 million.
But the biggest difference on the cash flow statement was deferred revenue, which is another way of accounting for that huge sum that all those schools, businesses, and organizations paid at the front of their period.
So because Zoom's business model is to get paid before it actually renders a service, that's why free cash flow was so much higher than net income.
If we simply take the roughly $1.5 billion in cash provided by operating activities and subtract out a little bit of capital expenditures, we get $1.4 billion in free cash flow.
So to compare and contrast, Netflix business model naturally makes it look like net income is higher than free cash flow, primarily because Netflix has to pay for content years before it can count it as revenue.
Zoom, on the other hand, has much higher free cash flow than net income because it collects all of the cash before it's done rendering its service. Now, in my own framework, I think looking at net income and free cash flow are both important. However, there's a really important distinction as to why I think free cash flow is more important than net income.
We'll explain all the details why next, but before we do, we want to give a shout out to this video sponsor, which is Quarter. Quarter's mission is to make every interaction between companies and their investors meaningful. Quarter does so by providing frictionless access to conference calls, investor presentations, earnings reports, and transcripts from markets all around the world straight to your pocket for no cost. I've personally been using Quarter for more than a year now, and I love how easy it is for me to access conference calls when I'm on the go. If you're interested in giving Quarter a try for free, simply visit the App Store of your choice and search for Quarter. That's Quartr.
All right, Brian. So if we remember the anti-fragile framework, it's predicated on what happens when black swans hit. For those that are unfamiliar, a black swan is a very rare, very difficult to predict event that pretty much affects everything that happens after it occurs. Now, we're used to thinking about the world that's distributed in an even way like this bell curve, and that is still true with things like a coin flipping contest or the birth weight of individuals. But increasingly, due to technology, we live in this different world that has long tails. We call it Extremistan, and that is where a small number of data points account for most of the difference. Think of it this way. Take the average income in your neighborhood and now change it if Jeff Bezos were to move into your neighborhood tomorrow. One person moving in, average changes dramatically.
Now, why is all this important when thinking about net income and free cash flow? Well, the reason is that 99% of the time, the world is fairly predictable.
However, we need to remember that 1% or sometimes even less of the time, a black swan arises.
And when these black swans arrive, they dramatically impact everything. Consider how much the world changed in the months leading up to 9/11. Not much impact at all.
However, a simple 5-hour window on that one morning affected everything about how the world functioned moving forward.
So 99% of the time, we live in a predictable world where we can count on things like net income.
But 1% of the time, we live in an unpredictable world that's governed by black swans. And when those events hit, it's good to have cash on hand. That's why it's important to look at both things. Net income does give you a good picture for how a company is being built for the long run, but free cash flow is important for when black swans hit, and that's why it's all that matters for my framework.
Now, I think it's fair to say that both of us will continue to look at net income and free cash flow indefinitely. However, like you, when I'm forced to choose between the two, I'll personally take free cash flow every single time. Now, it's also worth noting that not all net income is created equally. There's huge differences in net income when you're looking at GAAP or non-GAAP accounting. If you want to learn more about that subject, click the link you see on your screen. Brian's out.